Are you struggling with debt? Do you want to take control of your finances? Today, we're going to share 3 powerful strategies to eliminate debt and achieve financial freedom. Hi, my name's Joe Harris, and I'm here with Nick Morgan. We're both from Morgan Financial. How you doing, Nick?
I'm doing great, Joe. How are you?
I'm doing pretty good. What are we talking about today?
So we're talking about debt.
I love debt.
Well, that's, but we don't love debt.
No, we don't love debt. True.
Yeah.
We sell money for a living, but we always help people get out of the money we sell them.
Right. Exactly.
It's a means to own the house and towards financial freedom. It's a tool if used properly.
Exactly. Yep. You definitely have to, again, like you said, we sell money, we sell debt essentially, but you have to manage that value that you're working with for sure.
There's a big advantage to leverage and debt. You know, it allows people to buy houses and pay it off over time and grow equity and things like that. But there's some disadvantages as, credit card debt, consumer debt, high interest rates. These things can be tough to get out from under if not properly handled. And there are some ways to help people with that.
Right. Yeah. And that's what we're going to be talking about. Like you mentioned in the intro, three ways to manage or eliminate or just work on that debt part.
Yeah,
of your life.
we have 3 ways. I have a 4th bonus way. I didn't really want to put that in the title, but I also have a bonus. Number 4 is a little bit of a bonus.
Sweet.
So
sounds good.
Cool. So debt. When you look at debt, debt creeps up on people. Sometimes they just start it as, I'm going to pay my credit card bill every single month that I get it. And everyone has good intentions, but then an emergency happens.
Yep.
Oh, my kids need braces or emergency dental work, or maybe not everything revolves around dentistry. I just know my kids have to have, 2 of my boys have to have all their wisdom teeth taken out this summer. Yeah. And it's an unplanned expense, and these things without insurance was like $3,200. But with, if you pay cash, I think it's like $800, but it's an expense I didn't expect to come up. And, a lot of people would go and put that on the credit card, right?
Yeah.
And then it creeps up. It's like, the bill comes, you're like, well, I'll just pay the minimum this month. And next month, another expense. Every month an expense comes up. If you're an adult with children,
right, or
even adult without children, your tires, you need new tires on the car, and they're not $200 a piece anymore or $100 a piece. They're $200 a piece now. And inflation's got us all. Well, there's some strategies you can use to help once you get in this debt, however it happened. It's not like everyone goes in life saying, I'm going to get in as much debt as I can.
Right.
But things happen. Unforeseen things happen. And for this reason, we have 3 great strategies, a 4th bonus one. But before we get all into that, you have to take a look at your finances and say, what's causing, if you have debt, it's because you brought this much money in and you spent this much.
Right.
If for those of you who are listening on a podcast, you're bringing in less money than you're spending. And that causes deficiency, a gap. And so the first thing you have to do before you get into the strategies to pay off the debt, you really have to look at why you're in debt to begin with. So if you don't have a budget, and this is not a budgeting podcast, but if you don't have a budget or if you don't know where your money's going, that's really the first thing you got to do. You have to look at your budget and say, why am I bringing in less money or putting out more money than I'm bringing in?
Right, yeah.
And you have to eliminate the non-essential expenses because you have to bring it at least down to, so what's going out is what's coming in.
Right.
That will stop the bleeding.
Right. So just try to get the baseline first and foremost.
You got to figure it out. You got to look at where is my money going. There's lots of apps out there for this. Lots of apps out there that will help you track your spending. Your bank might even have an app that will help you track your spending. And that's the first thing you want to do. Where is my money going?
Okay.
And once you figure out where your money's going, you can say, well, I don't need that. I don't need that. And then you can eliminate it. But you have to have some kind of a gap between what you make and what you spend so you can use that money properly.
Right. Yeah. Totally makes sense.
Yeah. So let's talk about the first one.
Yeah.
The first one's called a debt snowball. So this first technique is you essentially are going to pay off all of your lowest balances first while making the minimum payments on the other ones. If you have multiple credit cards, if you're in debt with multiple credit cards, you take the one with the lowest balance. You make minimum payments on all the other ones, okay? And you pay off the one with the lowest balance first. And then when you're done paying that balance off, you took all the money you were paying on that one plus the new minimum on the next lowest balance, and you pay that one off. And you keep snowballing this so you have more and more to pay off the next debt. It's called the debt snowball. So again, the first one, you take your lowest balance first and you work at that. And once you've paid that off, you go to the next lowest balance and use all what you were paying before plus the minimum on that one to pay that one off. And when that's paid off, you snowball it into the next payment.
Right. Yeah, no, that makes sense. So like whatever you're saving from the ones that you then paid off, you can start working it into the
next one.
And bigger and bigger as you go along. I like it. I like the name too.
Yeah, debt snowball. It's fun because you can have that visualization of that snowball running downhill, capturing more snow and becoming bigger and bigger at the end.
Yeah, totally. And now is there any I guess we'll go into the other methods, but like, is there an alternative to that?
The con to this might be you might end up paying more interest on this debt because the lowest balance isn't necessarily the one with the lowest interest rate or the highest interest rate. Now, the next number 2 is the debt avalanche. Okay.
Even better.
I love these snow terms. So the debt avalanche means that you're actually paying off your highest interest credit card first.
Okay.
Highest interest credit card first. So it doesn't matter if it's the lowest or the highest balance.
Right.
It's just the one that has the highest interest because that one's going to tax you the most, right? If you have a credit card that's at 29%, which some of them are right now, you want to pay that off before you pay off the 9% credit card or the 0% no interest financing loans that people get. You want to focus your time on the ones that's going to cost you the most. You want to get rid of that the fastest.
Okay.
Right? Then you work on your next lowest or the next highest interest rate, and then subsequently the next and next and next until you're all paid off on your debt.
Okay.
But again, both of these situations mean that you have to stop the bleeding from coming in, and you have to not only stop the bleeding, is have some kind of a balance or a budget where you have a little bit of free room to pay extra. So that's something if you're a solo single person, you can look at it yourself. But if you're married and with children, you really have to sit down with your spouse and say, hey, listen, we need to get on the same page of being on this budget because we're going to use the debt avalanche or the debt snowball method in order to pay off all these things.
Yeah. So really itemize everything out and just like see, because there's always stuff that we can minimize or maximize. Right. On a day-to-day basis. And
there's a lot of things that we don't even realize. Like a lot of these, everything is subscription based now. It used to be, I got rid of cable to reduce my cable bill and I end up paying a lot more because I have it scattered across all the, the Netflix, the Hulus,
exactly,
all the Primes and all these things. But you want to make sure you can get rid of those expenses. Now the third method is called debt consolidation. Okay, so we have the debt snowball, the debt avalanche. I wish there was a cool snow-themed name. We probably should have put a little more thought into that.
I was thinking that one too. I was thinking
debt consolidation. Yeah, I don't even know what that would be.
It's like a snowball, something. Yeah.
Yeah, right. But so the debt consolidation means you wrap all the loans. Let's say you have multiple credit cards or multiple loans that you want to get rid of. You wrap that up into one loan. All right.
Okay.
And then hopefully that loan will have a lower interest rate, so that you focus on that one piece and you pay that one thing off over time.
Okay, so that makes sense. So if you had multiple different debt avenues and that average interest rate, like let's say it's 29 and 21 and whatever, hopefully you can consolidate it and get it under whatever that average is. Right?
Yeah, your holistic rate there, your weighted average of rates, you take that and if it's a lower rate, well now you're going to have lower to pay off. Now there's a couple of consumer type debt consolidation out there, and there's personal loans, private loans, bank. I might have a signature loan, but the bonus I was going to give you kind of ties into this debt consolidation, and that's really, if you have a house with lots of equity, people right now are saying, look, I have a 3% interest rate. I'm not refinancing that, but yet at the same time they have all this credit card debt at 29%.
Yeah.
So that is killing them on the cash flow basis because the minimum payments, depending on how great that debt is, those minimum payments can be strangling.
Yeah.
And so what's nice about and I'm not telling people to run out and get a bunch of debt, then use their house as a cash cow and as their savior. But literally it might be the savior for some people. And, if you have a 3% interest rate, obviously that's great and your payment's going to be low. But what's your total debt picture look like? And if your total debt picture and your cash flow that goes out versus what comes in is at a disadvantage, you might actually increase your cash flow by consolidating your debt, paying it off with a cash out refinance on your home, and having a fixed rate of return on that.
Yeah.
And so even the higher interest rates loans right now are still below what well below what credit cards are.
Right.
And so this might make sense for some, but you need to work with a skilled loan officer to understand the total debt picture and the weighted averages on that money. So basically, if a lender like us, I mean, we do cash out refinances, obviously, but if a good lender, looks at your situation and says, look, if you do a cash out refinance, you pay these debts off, your loan amount's going to increase to this, your new payment is this, versus what your old total payment was.
Right.
And then you take the extra money you're saving and put it back into the house, you're going to pay that loan off a lot faster.
Right. Yeah.
And all of your other debt as well.
No, yeah, that totally makes sense. I mean, again, like even if it's a 7, 8, not even as a 10% rate on your mortgage, right? It might be better than some credit cards.
It may make sense, but you really got to look at the dollars and cents and the cost versus the benefit. And obviously there's a cost to refinance, and obviously a 7% is higher than a 3%. You know, I'm not quoting rates, I'm just talking in generalities, but you want to make sure that the cash flow makes sense, and then the added benefit can go back into the loan to pay it off faster. Well, let's do a quick recap. So first of all, if you're not a subscriber, please like and subscribe and share this content with anyone who you might think will benefit from it. And, you know, today we obviously talked about 3 different methods to paying off debt. But remember, the first thing you want to do is look to see where your money's going. Where is your money going? And is it, you know, can you reduce your expenditures to bring it down so you're not, you know, expending more than you're bringing in? That's key. The next thing is you got a budget. You know, have a budget and a plan, whether it's yourself or your family, your spouse, boyfriend, girlfriend, whatever. Work with them to get everyone on the same page on this budget, because that's going to make a big difference in being successful or not. And you have to be disciplined when it comes to this stuff. And so the 3 methods we talked about were the Snowball Method, which is basically paying off your lowest balances first and then snowballing that extra money every time into the next lowest payment. The debt avalanche, which I love that term, debt avalanche.
I do too.
But that's getting rid of the highest interest rate debts first and then working your way down to the lower interest rates. And finally, we talked about debt consolidation. There's a lot of debt consolidation loans out there. Just be careful you're not working with one that will ruin your credit by defaulting on payments or renegotiating. Maybe that's the right route for you, but that causes other problems. I don't know enough about it to say anything other than I've seen it cause some problems, but it might be worth something looking into. But if you have a home with equity, that might also be a great way to consolidate your debt, have one payment, and if the whole picture looks right, it could even make sense even if you're in a 3 or 4% interest rate right now. So if you have any questions on any of these things, please reach out to us anytime. Our contact information is below. You know, send us a message, call us, email. If you have a carrier pigeon, we'll accept that too. But that's all I got here today. Hope you enjoyed this show today. And if you have any questions, please reach out and we'll see you next time.